Ever feel like you need, I don't know, a special decoder ring just to figure out what economic news actually means? And more importantly, how it connects back to, your life.
Oh, absolutely. It can
Yeah.
definitely feel like a whole other language sometimes. Lots of headlines, lots of jargon.
Right, because at the end of the day, this stuff, it impacts what we pay for things, the jobs that are out there, even where we might think about putting our savings.
Exactly. And that's really what we want to do here today. Cut through some of that noise and hopefully shed some light on what actually matters for you.
Perfect. So in this deep dive, we're going to tackle 3 big U.S. economic stories that have been making headlines recently. We'll try and break them down, aiming for those uh, moments.
Sounds good.
Yeah.
We're looking at the Treasury Secretary's policy ideas, what the Federal Reserve might do with interest rates next, and also a warning that came out from Jeffries about the stock market.
Yeah, consider this your kind of quick guide to getting up to speed. We're not just going to read the news, but really dig into why it's important and what it could actually mean for you listening right now.
Exactly. Less information overload, more useful insights.
Okay, so where should we start? How about the Treasury Secretary's plans? That seems like a big one.
Yeah, let's do that. So Treasury Secretary Scott Bessent has been talking about a sort of a 3-part plan.
Okay.
First, cutting back on regulations for businesses. Second, tax cuts, both for companies and individuals. And third, raising tariffs on goods coming into the country.
Right. Deregulation, tax cuts, tariffs. So what's the thinking behind that? What are they trying to achieve?
Well, the main goals seem to be about making the U.S. a more attractive place to do business.
Mm-hmm.
The idea is, less red tape, lower taxes. That might encourage companies to invest more here.
Okay. Invest more, maybe expand, hire more people within the U.S.
Precisely.
Yeah.
And the tariffs part, raising taxes on imports that's aimed at making American-made products relatively cheaper or more competitive, you could say.
So boost local manufacturing, create jobs here. That's the theory anyway.
That's the core idea, yeah.
Yeah.
Stimulate the domestic economy, encourage people to buy American, essentially.
All right, let's get down to brass tacks then. How does this potentially affect someone just, going about their day? What are the tangible things we might see or feel?
Okay, well, one pretty direct thing could be the price of imported goods, those tariffs. If they go up, it costs more to bring things in.
Things like backups?
Electronics, yeah, maybe appliances, even some types of food, potentially. If it costs importers more, chances are retailers will pass at least some of that cost onto you, the consumer.
So that new phone or washing machine you were eyeing, it might get a bit more expensive.
It's definitely a possibility. On the flip side, though, the intended effect is job growth in certain areas.
Like manufacturing, you mentioned.
Manufacturing, maybe construction, energy sectors.
Yeah.
If the policies work as planned and incentivize companies to produce more domestically, they'll probably need more workers.
It's interesting how these things can push and pull, isn't it? Cheaper, potentially, to make things here, but maybe more expensive to buy things from elsewhere.
Exactly. And it also brings up the question of who really benefits and how quickly. Some economists worry that, big corporations might see the upside from tax cuts faster.
While the impact on, say, an average worker's paycheck or job security might take longer, or maybe not happen evenly across the board.
Right. That's often the debate with policies like these. There's usually a lag, and the effects aren't always uniform. We've seen similar discussions before, haven't we?
Yeah, definitely. So it sounds like there isn't really a consensus among economists. Some see growth potential, others are worried about inflation or hitting consumers' pockets.
That sums it up pretty well. You have predictions for boosted growth, but also warnings about potential downsides like higher prices for consumers. It really depends on a lot of factors playing out.
Okay. Which actually leads us nicely into the next big piece, doesn't it? The Federal Reserve and interest rates.
Yes, the Fed. Always a crucial player.
So, just as a quick refresher, the Fed is the U.S. central bank, and they manage things like interest rates, try to keep inflation under control.
And keep the banking system stable, yeah. They have a few tools, but adjusting interest rates is probably their most well-known one.
And interest rates are basically the cost of borrowing money, right? Lower rates mean cheaper loans, which can boost the economy.
Generally, yes. Lower rates make it cheaper for businesses to borrow for expansion or for people to get mortgages or car loans. That tends to stimulate spending and investment.
And higher rates do the opposite, slow things down to fight inflation.
Exactly. Higher rates make borrowing more expensive, which can cool down an overheating economy and help get inflation back under control. The key rate they manage is the federal funds rate, which influences all sorts of other loan rates.
Okay, so given everything we've just talked about, potential inflation from tariffs, maybe some economic uncertainty, what's the expectation for the Fed's next move? Are they likely to cut rates to give things a boost?
Well, despite some pressure, maybe, the general consensus right now is that the Fed will probably hold interest rates steady. They're likely not going to cut them at their next meeting.
Holding steady. Okay. And why is that? What's the main reason?
It really boils down to inflation. Even though it's come down a bit from its peak, it's still running higher than the Fed's target level.
So they're worried that cutting rates now might just fuel inflation again, make prices rise faster.
That seems to be the core concern. They want to be really sure inflation is truly heading back down to their, 2% target before they start easing up. Cutting too soon could undo some of the progress they've made.
Okay. So for you listening, if you're thinking about buying a house, getting a car loan, maybe starting a business that needs funding, this means borrowing costs are likely to stay, well, relatively high for a while longer.
That's the likely implication, yes. It could remain challenging, or at least expensive, to borrow money compared to, say, a few years ago.
Not great news if you need a loan, but the Fed would argue it's necessary to stop prices spiraling, right?
That's their perspective. Their main job is long-term economic stability. And right now, that means keeping a firm grip on inflation, even if it causes some short-term economic headwinds. It's a balancing act.
Definitely sounds like walking a tightrope. Okay, so we have government policy pushing one way, the Fed holding rates steady. What's the view from Wall Street on all this? That brings us to Jefferies.
Right, Jefferies. They're a major investment bank advising big institutional investors, so their perspective carries some weight. And recently, they've been sounding a note of caution about the U.S. stock market.
Caution? Why? What are they seeing that makes them a bit nervous?
They point to a few things. One is what they call mixed government policies, basically the potential conflict we touched on earlier.
You mean the tax cuts and deregulation aiming for growth versus the tariffs and maybe immigration limits potentially slowing things down or causing inflation?
Yeah. Jeffrey seems concerned that these policies might pull in different directions, creating uncertainty for businesses and the economy overall. That kind of uncertainty isn't usually great for stock prices.
Makes sense. What else?
Well, rising interest rates, or rather, rates staying high like we just discussed with the Fed, it makes it more expensive for companies to borrow money to invest and grow. That can obviously put a damper on future profits.
Right. Higher borrowing costs slow things down. And doesn't there something about AI too? The whole AI boom?
Yes, that's the third point. While everyone's excited about artificial intelligence, Jeffries is suggesting maybe the market's gotten a little ahead of itself in the short term.
How so?
They're questioning how quickly AI will actually translate into, big profit increases or real tangible product upgrades across the board. The potential is huge, yes, but they seem to think the immediate business impact might take longer to fully materialize than some stock prices currently reflect.
Okay, so a combination of uncertain policy, higher borrowing costs, and maybe some hype around AI needing to prove itself. So what does this mean for, say, someone with a 401k or other investments?
The most likely consequence is just more volatility, more ups and downs in the market. Your investment values might fluctuate more noticeably day to day or week to week.
So maybe buckle up for a bit of a bumpier ride.
That could be part of it. And for newer investors, it's probably a reminder to be cautious. Don't jump into risky investments without understanding them, especially when the overall market feels a bit uncertain. Avoid chasing hype.
But does uncertainty automatically mean disaster? Or can there still be opportunities?
Oh, absolutely. Uncertainty doesn't mean everything goes down. It just means things are less predictable. For savvy investors with a clear strategy and a long-term view, volatile markets can actually present buying opportunities. But it requires careful research and understanding your own tolerance for risk.
Okay. So in times like these, what's the typical advice from financial experts, the sort of standard playbook?
It usually comes back to the basics, really. Diversification is key. Don't put all your eggs in one basket. Spread your investments across different types of assets, like stocks, bonds, maybe real estate.
Makes sense. What else?
Try very hard not to make emotional decisions. Don't sell everything in a panic when the market dips, or buy frantically when things are soaring, just because of FOMO, fear of missing out.
Easier said than done sometimes.
It really is. Also crucial, make sure you have an emergency fund. Cash set aside for unexpected life events so you don't have to sell investments at a bad time. And finally, always keep your long-term goals in mind. Why are you investing in the first place?
Okay, wow. We've definitely covered a lot. We've gone through the Treasury's plans, the Fed's interest rate stance, the warnings from Wall Street. It still feels like a lot of moving parts.
It absolutely is. But hopefully you can start to see how these things are connected, right? Government actions influence inflation, which influences the Fed, which influences borrowing costs and market sentiment. It's all linked.
Yeah, you really can see the ripple effect. So let's try and boil it down. What are the key takeaways someone should have in their head after listening to all this?
Okay, maybe three main things. First, government policies trying to boost business might also mean you pay more for imported goods. That's the potential trade-off.
Got it. Takeaway number one, policy boost versus import cost.
Second, the Fed keeping interest rates steady means borrowing stays expensive for now. That's their tool to fight inflation, even if it pinches borrowers.
Okay. Takeaway two, Fed holding rates equals pricey loans, but fights inflation.
And third, Wall Street is getting a bit cautious because of this mix of policies, rates, and maybe some tech uncertainty. That could mean more ups and downs in the stock market ahead.
Takeaway three, market caution, potential turbulence.
All right, so putting it all together, sounds like a potentially tricky environment.
You could say that. Jeffries actually used the phrase high risk but high opportunity environment, which I think captures it well. Things are uncertain, which creates risk, but also potential openings for those who are prepared.
Which really underlines the need to be informed and thoughtful about your finances, doesn't it? Absolutely. More than ever, perhaps. Careful planning, staying informed like you're doing right now, by listening and maintaining that long-term perspective are really vital in times like these.
So for someone listening, maybe feeling a bit overwhelmed but wanting to take positive steps, what can they actually do, regardless of how much they know about finance right now?
Great question. First off, just keep learning. Keep engaging with information like this. Understanding the basics goes a long way.
Okay, keep learning. Step one.
Step two, focus on the fundamentals you can control. Stick to a budget. Watch your spending. Avoid unnecessary debt. And critically, build up that emergency savings fund. Having that cushion is incredibly important.
Budget, save, avoid bad debt. Got it.
Third, maybe start learning about investing, even if you're not ready to put money in yet. Understand concepts like diversification, risk, compound growth. There are tons of resources out there.
Learn the basics before jumping in. Makes sense. And definitely steer clear of those online promises of getting rich quick, right?
Oh, absolutely. If something sounds too good to be true, it almost certainly is. Be very skeptical of hype, especially online.
Solid advice. Anything else?
Just reiterate that long-term view. Financial well-being isn't built overnight. It's about consistent, informed decisions over time. Try not to get too caught up in the daily noise.
Fantastic. Well, this has been really insightful breaking down these complex topics. So maybe a final thought to leave everyone with. Considering all these dynamics, government policy, the Fed, market signals, what's maybe one specific area of the economy you'll be paying extra close attention to in the coming months? It's something for all of us to think about, really.
That's a great question to ponder. How will these forces actually shape things moving forward?